Hey, students of iMarkets Live! The following Crypto Academy video is designed to help you understand the psychology behind trading with algorithms and being directly involved as a market participant. Trading can contain substantial risk. By watching this training, you agree to the terms of this disclaimer and accept full responsibility for your own investment decisions. This lesson will focus on answering the following questions. Before we continue, pause the video, read through them, and be certain to minimize any distractions. After you've found yourself in a position, what actions do you take? Do you have a planned target? Is it 50 pips, 100 pips, 500 pips? You see, our expectations with trading must remain flexible, especially when we acknowledge the importance of algorithms in the marketplace. Looking at the orders flowing on our screen right now, would you close your position? If you were selling whatever currency pair, whatever crypto that is out there, when is it that you decide to make it a risk-free trade? You see, a lot of the time, as we find ourselves watching and waiting for the market to move, there will be certain confirmations that are given to us on a technical level. We can do all of the fundamental research in the world. And when the sentiment is backing our analysis, when we find ourselves feeling confident in the moment, when we find ourselves identifying large influxes of orders that are moving the market on our side. With cryptocurrency, using the order books and trading with algorithms is an effective way for you to gain practice towards achieving that self-mastery and that ability to trade cryptocurrencies with leverage. On a margin account, using whatever risk management you feel comfortable with. In times like this, where the order flow is moving in your favor, and you can visually see the sentiment, human beings and algorithms contributing to the price movement, a 50 pip target can sometimes be achieved in minutes. Being strategic with the way that you approach the market is going to allow you to identify correlations. It's going to open your mind to the possibility of you being a consistently profitable trader that generates whatever income you desire. Notice how right now this trade that's going on the screen, we're looking at the Bitcoin order book. We're seeing sells and sells and sells, and it's almost as if there is an infinite amount of volume that's contributing to the movement of price down. But this chart and this trade is not taking place on Bitcoin. It's on a different marketplace. Right now, the position that we are evaluating is Ripple. And so you can utilize the Ethereum order book. You can utilize the Bitcoin order book. These major cryptocurrencies, more often than not, correlate fairly consistently with a lot of the altcoin movement. And you're going to find at times where you look at the market cap and the sentiment for some of these major cryptocurrencies over a 24-hour period, over a 7-day period, over a 30-day period, they come to a point where you're seeing specific gains or losses for that asset, and then it correlates with a lot of the other altcoins simply because of the process with how connected cryptocurrency truly is. And so when you do trade with margin, if you find yourself in a position where you've done analysis and you've set out certain expectations for that trade, secure your profits, use trailing stops, pay yourself. And then that way, you can evaluate on a position, and you can also find yourself coming from a place of having certain expectations. When you're planning out positions, no matter what the market is, there will be times where you had that 50 pip goal and the market hit it and you took profit, and then the market continued to move for another 50 pips. Your response and how that makes you feel is going to determine the next action that you take. When you do take profit, you took profit for a reason. Whether that was because it achieved your target, whether that was because the market was giving you conflicting signals, and something significant changed to the point where you feel like the market could start to move in the opposite direction. So, as you're doing some assessment on the current market environment, you just hopped out of your trade. Is it time to trade it in the same direction? Is it time to open a buy? In times where you feel confident and you have some guidelines within your trading plan and within your own personal preference for how much emotion you can take when it comes to participating in the market. When you do identify thin order books, and when you notice certain technical patterns, and when you notice what the trend is telling you, when you notice that your plan of action is something that you choose to follow on a consistent basis, that is when you're going to be able to find yourself taking positions in the market, thinking for yourself when it comes to how much leverage you use, what size of positions you take. And these market correlations, although they are not always perfect, when the market gives you that signal, act with confidence. Don't fear drawdown. The market is our friend. I am so happy and grateful to have the opportunity to participate in the largest financial industries in the world. And even in those times where the market does not necessarily go in the direction that I believed it was going to go, I know that the market is only going to move to a certain point. And then once it arrives there, it is either going to experience a pullback, a complete reversal, or I am going to make the educated decision to come to a place of saying now is time to hop out of the trade. And this is something that I really do feel that you have the ability to implement right now. It's that idea of recognizing when it's time to walk away from the trade and when it's time to realize what trading rules have you even been following up to now. Do you utilize limit orders, or do you always find yourself taking market executions? How many pips is your target? What is your reward to risk on a trade? Where do you set your targets? How far do you allow price to go against you after you've entered a position and you've effectively identified an opportunity, something that you want to happen, something that you believe is going to happen, something that you really, really, really feel confident about. These moves require patience. It requires persistence to show up to the charts every single day and find yourself doing analysis in your own unique way with proper rules in place to allow you to manage your position, to allow you to trade with the algorithms and not be fearful in those times where price seems as if it just won't go in your direction. Where you're waiting for 5 minutes, 15 minutes, 60 minutes, an entire day. And price slowly just continues going the opposite way. How far do you let those trades go? Algorithms do not consider human emotion, although at one point in time, they were programmed by human beings that had certain thoughts, that had certain beliefs, that had certain expectations. And right now, if you're noticing that the price of Bitcoin seems to just be rising and rising, it's gone up about $50 or 50 pips. And just like that, we see the price of the trade that we're analyzing go up by over 50 pips. But it seems like there's something stopping this trade from really progressing. And you can see right there that for a moment it seems as if the trade got stopped out. But now it's still moving, we're still in the position. Nothing is happening when we look at the order. It seems like it's unresponsive. And so there will be times where you experience slippage and maybe even a little bit of market manipulation, depending on where you're trading. And how you respond to that is going to determine how successful you are in the long run, simply because when you are trading and your position gets closed out, and then you see that minute by minute price has continued to climb after you identified the lowest point or the highest point, after you set up a predetermined target that price eventually found itself to, and then you find yourself still there, still trading, and you take another position. Maybe it's not the most precise entry, and the algorithms continue to move price against you, and you experience some additional drawdown and don't have the opportunity in that particular moment to maximize the potential profits that you'd make from taking that entry. You can have all the market correlations in the world, but when you're trading with algorithms, realize that these robots do not care if price goes against them because they have predetermined rules that say now is the time to enter a trade or now is the time to walk away. And we as human beings can develop that same discipline. We can have a very systematic approach when it comes to how we choose to participate in the markets. And so, in those times where you feel confident, but there is an element of hesitation, what do you do? What steps do you take? If I were you, I would constantly be reevaluating because all of the decisions that you make, not just on the chart, but throughout your day, are going to influence the results you experience. And so if you can't handle drawdown, if you can't handle price moving against you by 20 pips, 50 pips, 100 pips. Really take a close look at your risk management and gain even more clarity on how that's going to translate into you meeting or exceeding your objectives. And in those times where you find yourself in a position and the bias hasn't changed, you're still confident that price is going to move in the direction that you've identified. Whatever time frames you've considered, whatever technical patterns you've analyzed, once you've taken that position, if it stops you out but the analysis hasn't changed, maintain that confidence. It's okay to get stopped out and still have the same bias and re-enter the market. It's okay to get stopped out and feel as if that particular analysis just didn't play out. It's okay to trade in a way that you feel comfortable with. And right now, price is 80 pips in the opposite direction from where I chose to enter the market. But the bias did not change. There was a threshold in place where, yes, if price did continue moving, this trade would have been closed out. But creating those expectations for yourself, ideally finding yourself in positions that are a minimum of for every $1 that you risk, the reward can exceed that. You won't always find yourself in those types of positions. Sometimes it's okay when price comes back to break even to close out of that position. It's okay when price moves a little bit into profit to make it a risk-free trade, to close out 20%, 50%, 70%, that entire trade. Because when you take profit, it's impossible to lose on that position, even if price does continue to go your way. And understand that the volatility and the true nature of these markets, foreign exchange and cryptocurrency, they're very volatile and price can change drastically in any given moment. A trade that was once 80 pips in the opposite direction from your entry can shift you into profit within the same minute. So it does require patience, and it does require a certain belief. It does require emotional strength, and it does require resilience when you're going to be utilizing leverage and participating in the cryptocurrency markets. The average pip movement for any currency pair in the foreign exchange is fairly different, but the underlying principles still remain the same. Once you've identified the setup, choose to act without hesitation. Have your targets in place. Don't be afraid to re-enter the market, and realize that it is also okay to just sit on your hands and wait for more information. You don't always need to be in a trade. You don't always need to be in the market. The algorithms, when we choose to trade with them, when we identify opportunities that are in our best interest to act on, when the reward to risk is favorable, these types of positions combined with risk-free trading is going to mitigate the emotional response that you feel, because after that trade has shifted into profit and you realize that there may be a potential for that trade to come back and take you out. It's in those moments where if you second guess yourself, just choose to take profit. You will never lose in the market if you take profit. And these algorithms can be very unforgiving. If you find yourself trading in the opposite direction, it's in those moments where price can move 50 pips, 100 pips, 500 pips against you. And if you don't trade with a stop loss, that can be detrimental to your account. It's okay to not put a physical stop loss in the market if that is the way you choose to trade, because the way that I see it, by putting in a physical stop loss, you become a target to the market makers. You become a target to the individuals that can see those orders and that want to get you out. You could have identified the most high reward, low risk opportunity in the world, and price went 100 pips in your direction, and you made it a risk free trade, and then a gap happened, you got taken out of the market, and suddenly that was the last time that price ever revisited that particular area in the market. So it's okay to act in whatever kind of way you feel confident in when you are trading with leverage. And understand that this is a process. It takes time to have the confidence to enter the market without hesitation. It takes time to develop the emotional resilience to sustain your position through times of drawdown. It takes time to recognize when it is time to utilize margin trading as a part of your strategy to offset some drawdown that you experience with investing. And all of this taken into consideration, trading with algorithms is very powerful if you take the time to study and practice so you can find yourself trading in the exact same direction. Pay yourself, because you can never lose if you take profit, and every trade presents a learning experience. In summary, trading with the algorithmic market direction during a movement from one zone to the next is a powerful way to meet your PIP goal for the day, week, month, or even the year when the right opportunity presents itself. Remember, we can trade when the market is rising or falling, and you have a strategic advantage over every other market participant out there. There is nobody else that can analyze the market in the way that you do. And if you do choose to incorporate algorithms into your methodology, whether that be through an expert advisor or through recognizing what the algorithms tend to do, ultimately, this is going to allow you to approach the market with confidence on a consistent basis and to remain level headed regardless of which direction the market decides to move in.